In today's video, we are going to be doing the Indianapolis rental market for multifamily properties. And just to give you an idea, since this is Monday, February 6th, 2023, this week we'll be covering Indianapolis today, Grand Rapids, Michigan tomorrow, Omaha, Nebraska on Wednesday, Rapid City, South Dakota on Thursday, and Cincinnati, Ohio on Friday. So it looks like for this week, we are going to stay in the northern central part of the United States. So as you can see, we have the Indianapolis metro statistical area outlined by CoStar. You can see we have Cincinnati over here to our east, Louisville to our south, and St. Louis to our west. You can even get a little peek of Peoria, Illinois, up here a little bit to the northwest. So let's take a look at our filters as we always do. We will be excluding corporate, military, senior, and vacation, and only including market and market affordable, so that we're only looking at conventional apartments. We'll look at all asset classes first, Class A, Class B, and Class C, and then we will look at only Class A, only Class B, and only Class C. So let's go see what the analytics tell us for the Indianapolis metro statistical area. Here is our supply snapshot. You can see that there are 1,587 properties in this MSA. There are 167,108 units. There are still 5,259 under construction, and 1,125 more people moved out of the rental market than rented into the rental market over the last 12 months, where in 2021, the rental market grew by 4,290. In 2022, it shrunk by 1,125, and we can see that with the vacancy rate, since the vacancy rate was 6% a year ago and it's 7.8% now. Although we're still seeing a year-over-year trend in rent growth, we'll see what it looks like quarter over quarter. As usual, we are only looking at the space market. We are not looking at the capital markets. Let's come on down and look at our long-term occupancy average. We can see over the last 22 years that this market likes to be right at 90%. So that is the stabilized occupancy for Indianapolis, and it is currently sitting at 92.24. So that is above the long-term occupancy average line. So it looks like on the face, looking at the snapshot, that this market is in the oversupply phase of the market cycle, above that long-term occupancy average, and we can call it on that side of the vertical line, or that side of equilibrium, because we've been seeing rent growth, but now we're seeing slowing in absorption and vacancy increasing. So that tells us we're heading down the other side. But let's see what the data tells us. So here is our data analytics for all three asset classes, A, B, and C. We can see that we will not be looking at asking rent. We don't care what they are asking. We only care what they are collecting. So we will only look at effective rent. It started 2022 in the first quarter at 1103, went up to 1154, very, very slightly up to 1155, and then slightly down to 1151. So big jump from first quarter to second quarter, with a $50, $51 rent bump, and then only up $1 and down $4. So we got some stabilization happening here, even with all that negative absorption. Let's look and see what deliveries and absorption tell us for all three asset classes. Delivered 276 in the first quarter and absorbed 592. Good, strong absorption, double absorption than what was delivered. So that's why we saw that large rent increase from first quarter to second quarter. Delivered another 456 units, but only absorbed half of them, 218. So the double that we absorbed here, we're now giving some of that back in the second quarter. And then, of course, we really start giving it back in the third and fourth quarter. So at this point, Even though we still had deliveries, 287 and 498 in third and fourth quarter, the market is now going negative absorption in both of those quarters. So this is telling us that we have hit that rent apex. But let's see what it looks like for the Class A's, and then we'll look at the B's and the C's. So let's go look at Class A. So here is our Class A data. You can see we have 94 total properties totaling 21,441 units. We are looking at the effective rent. And in the second quarter of 2022, in the first quarter of 2022, it was at $1,502 per month, went up to $1,584, and then down to $1,555 and down to $1,522. So the Class A started trending downward fairly quickly after the second quarter, so third and fourth started that downtrend. Let's see what the deliveries and the absorption tells us. So we can see here not much delivered, so it looks like Indianapolis has been delivering more in the Class B space than in the Class A. So we had no deliveries in the first quarter, but we did have some absorption. We had 216 deliver in the second quarter and had some more absorption. So a little more absorbed in the first two quarters than what was delivered, but then the negative absorption started occurring. More people were leaving the market than were renting in the market, and we still had another 62 units. So you're sitting here with about 278 units delivered, and it looks like it did absorb some positive, but only about 25 or 30 total absorbed over the 268 that delivered. So not a whole lot of deliveries here, but we're definitely hitting a point where the renters are saying, this is enough with these rents. Let's try and bring these rents down some. So I do believe that's what may be happening here, but let's go look at the B's and see what the B's are doing. By the way, what we're seeing in this trend does correlate with the rent. So demand supply is reacting appropriately so far with the Class A space. So let's go see what B's say. So here is the Class B data for the Indianapolis Metro Statistical Area rental market. We can see that there are 812 properties totaling 96,275 units. We are looking at effective rent, and in the first quarter of 2022, it was at $1,091, went up to $1,142, slightly up to $1,146, and then very slightly down to $1,145. So again, we're hitting about that rent inflection point on where this market is saying, maybe it's time that we bring the rents down a little, but it looks like it's stabilizing. So let's see what the deliveries and absorption tells us. So we can see that we had pretty steady deliveries like we saw in all three asset classes, and we did see that the majority of the deliveries were going to be in the Class B space, since there was only 268 delivered in the Class A space. So 237 delivered in the first quarter, 466 delivered. Okay, another strong absorption number, but then it starts getting weak. 240 delivered, only 155 absorbed, 287 delivered, and now an additional 379 go vacant, another 436 delivered vacant, and another 617 go vacant. So Class B space, we got pretty close to 1,000 negative absorption in the third and fourth quarter. So this is showing a little bit of a disturbing trend in the Class B space. If you're investing in Class B properties in Indianapolis, you may want to pay attention to this, because this is not a very good sign moving forward. We are showing a little bit of positive absorption and deliveries in the first quarter of 2023. This data is too young. I would not put any weight into this information at all. It may be erroneous. CoStar usually has about a 6 to 8 week lag. So I would not put any weight in these numbers yet. I'd wait until we get into the second quarter before we start looking at first quarter data. All right. So that's the Bs. It does look like we've got quite a bit of negative trend happening. Interesting that the rents were only falling a couple of dollars a month, but let's see what the Cs tell us. So here is our Class C data. We have 580 properties totaling 48,727 units. For our effective rent, we started the first quarter of 2022 at 928, went up to 964, up to 974, up to 979. So we've seen this story in a lot of markets. We do have increasing vacancy in every single quarter, which tells me we're probably going to be negative absorption in all 4 quarters. Let's see what the absorption actually does tell us. And as suspected, we are negative absorption, albeit just a little bit in the first, starting to get a little stronger as you get towards the fourth quarter. A little slow down in the fourth quarter of negative absorption, but that third quarter was pretty big. This says we should not have growing rents. Now, with the occupancy at 93%, that's a fairly stable occupancy, even though the market likes 90%. So you can argue that they could potentially be raising rents until they get to that 90 percentile. But as we know, most of these investors, they like to be above 90% so that they can get agency financing or qualify for agency financing. So I'd say these residents are tired of these rents. They're doubling and tripling up, and the owners need to take notice. Okay, so I think we have a confirmation here that the market is above the long-term occupancy average. The rents are definitely declining in the A's and B's. They are going to start that decline trend here very shortly in the C's because these owners cannot afford to just let these renters move out. So we'll start to see those decline soon. That does tell me that the Indianapolis metro statistical area is deep into the oversupply phase, but it is above, probably 1 point above the long-term occupancy average, but heading that direction towards the occupancy average. So somewhat of a better tale than what we've seen in a lot of markets, but definitely trending downward nonetheless. Moral to the story here, look at your quarter-over-quarter data, not your year-over-year data when you're looking to invest in these markets across the country. Okay, so that does it for the Indianapolis metro statistical area. We will see you tomorrow for Grand Rapids, Michigan.